This is a look at exercise 910, the alternate version of the same problem found on page 428. This problem is taking a look at warranty expense and liability computations and entries. The problem reads that Hitsu Company sold a copier costing $5,500 with a 2-year parts warranty to a customer. It was sold on August 16, 2016 for $11,000 in cash. Okay, so they made a sale for $11,000 for something that cost them $5,500. But they offered a 2-year warranty on this to the customer so that if it goes bad, they're likely going to repair or replace it. It says that Hitsu uses the perpetual inventory system. On November the 22nd, 2017, the copier requires on-site repairs that are completed that same day. The repairs cost $141 for materials taken from the repair parts inventory at Hitsu. These are the only repairs required for 2017. Based on experience, Hitsu expects to incur warranty cost equal to 5% of dollar sales. It records warranty expense with an adjusted entry at the end of each year. Okay, so let's just kind of recap what's happening here. The company sells copiers. They offer a 2-year parts warranty on the copiers. Something goes bad in the 2-year period, they'll come out and replace the parts for free. They don't know if they're going to have to replace things or not in the next 2 years for every copier they sell, do they? But based on their experience, they say, you know what, for every dollar we have in sales, we typically have about 5% in repair costs. But they recognize the sale in one period. That expense for that warranty, the expense for the parts they have to replace under the warranty, those will be in future periods. There's a violation of a key accounting principle that the company can't realize revenue in one period, but expenses tied to the same revenue transaction in a future period. That violates the matching principle. So generally accepted accounting principles say that when you sell something with a warranty, you need to estimate what that warranty expense is going to be. In the same time, the same period that you take that warranty revenue, also recognize some estimated warranty expense. Now, you're not actually going to put out cash for that warranty expense now or give up parts right now, so instead set that up as a liability, something you're liable to do in the future. And then in the future, as things go bad, take that cost for those parts, the cost for recognizing the repairs on that warranty, out of that liability that you set aside. So let's take a look at the transactions. First off, the first question says, how much warranty expense does the company report in 2016 for this copier? Well, we know that they sold something for $11,000. They have revenue for that period. In the same time that they sold the copier, they're also going to take an expense, a warranty expense. How do they determine that number? They guess. It is an estimated warranty expense based on historical information. They say every time we sell something, about 5% of that cost, about 5% of that sale is the cost that will incur in the future typically to repair that particular item. So it's real simple here. 5% of $11,000 gives us a warranty expense of $550. Okay? That helps put things into GAAP. Lets us follow the matching principle. They'll recognize then in the period the sale. They're also going to recognize in the period an expense. Even though that expense isn't going to be called upon until the future, we're going to recognize it now. And instead of this little reserve account called a product warranty expense liability. How much is the estimated warranty liability for this copier as of December 31st, 2016? Well, this sale happened in August of 2016, and if this is the only sale, that amount of $550, there were no repairs done for this in 2016, so there would be 0 repairs. Therefore, our estimated warranty liability would be just the amount for this one and only sale that was made in the year. $11,000 times 5%, estimated warranty liability is $550 still. The next question is, how much warranty expense does the company report in 2017 for this copier? Well, since the copier was not sold in 2017, there's no warranty expense reported for 2017. When was the copier sold? 2016. When do you take an expense for the sale so that you're not violating the matching principle? In the year that you sold it, 2016. So in 2016 was the only year an expense was taken. Why? Because that's the year the sale was booked. Next question. How much is the estimated warranty liability for this copier as of December 31st, 2017? A little trickier here. Let's go back and visit that previous T account. Remember, we started off at the end of 2016 with that $550 amount that we kind of put aside for future repairs. Well, what happened in the future? In the future, 2017, there were some repairs of $141. Oh, so some of that estimated warranty liability is being used up. How much is being used up? $141 for the 2017 repairs. Okay, well then what's the estimated amount left over that we think we'll have to make repairs on for this copier? It's just the difference. Subtract the smaller number from the larger number, and we'll still have a credit balance on the estimated warranty liability of $409. Okay, moving right along, it says prepare the journal entries to record the copier's sale. All right, so this is pretty straightforward here initially. We know that they get some cash of $11,000 because they sold a copier, okay? And they're going to credit sales for $11,000 for that copier on the date the copier was sold, August the 16th. And that is the journal entry to record the cash sale of the copier. Something they gave up, though, for this copier. When the customer took this, what goes down for the company? It's inventory. That inventory is going to get expensed out as to be called cost of goods sold. So the amount of cost of goods sold is the amount of the unit cost, $5,500. And that's going to be reduced in inventory by $5,500 as well. Now they're asking us to prepare the journal entry to record the adjustment on December 31st to record the warranty expense. Remember, this is that estimated amount. We already calculated previously. It was 5% of $11,000. We know that we're putting aside $550 to cover future repairs. We are putting that aside in an account called estimated warranty liability. We're liable to do something in the future. What are we liable to do? Repair the copier when it breaks down over 2 years. What's the cost we think will incur in the future for this liability? 11% of the sale, or $550. So we expense out that amount that we're putting aside. That entire $550 that we're putting aside in the future is that amount we think we're liable for in the future. We take that entire amount as a warranty expense right now. And the simple entry is debit warranty expense for $550 and credit estimated warranty liability for $550. Prepare the journal entry to record the repairs that occurred next year, November 2017. Okay. Remember what the repairs cost? Repairs cost $141. We're taking that out of inventory. So what's happening in inventory? Inventory is going down. Inventory goes down with a what? A debit or credit entry. We're going to credit inventory for $141. And the offset, that debit, that thing we set aside in the future to use, we set aside that estimated warranty liability. It had a credit balance of $550. How do we use some of that up? Well, we debit for the portion used up, in this case for $141. So debit estimated warranty liability for $141 and credit repairs parts inventory for $141. And that finishes up the transaction on how to record estimated warranty liabilities.